Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
Our focus today is OSR Holdings, Inc., ticker OSRH. It's a microcap biotech that has become completely divorced from any standard financial analysis. It's really existing in what you could call a dual reality.
Right. And we're looking at a situation it's a profound statistical rarity. OSRH is trading near 60 cents right now. It's shed over 90% of its market cap from the highs. And yet, when you dig into the forensic data, the market structure is under this extreme, almost contradictory tension.
And that tension is defined by some very specific, really mandatory market anomalies. We've got a reported short interest that exceeds 323% of the free float. Just think about that. The shares that are available to trade have been borrowed and sold short more than 3 times over. And to compound that, the annualized borrow fee, so the cost for shorts to keep their position open, is sitting at 134.9%.
Yeah, and while those mechanics seem impossible, the stock price tells a very different and, I would argue, a very rational story of failure. The volume is high, the price is low, and the market cap is just eroding day by day.
Exactly. So the central question we have to get into is this. Does this extreme short interest define OSRH as a market structure anomaly that's poised for a massive mechanical reversal, what some would call a super squeeze, or is the stock price, down near 60 cents, just a rational reflection of the underlying governance risk, the financial insolvency, and the systemic dilution?
My position is that the technical pressure here creates an asymmetric opportunity that frankly overrides the fundamental failures. And I'm going to argue that those extreme market mechanics are just a catastrophic symptom, maybe even a predatory side effect of catastrophic corporate governance and a complete failure of fiduciary duty. It makes OSRH, in my view, fundamentally uninvestable, regardless of any trading mechanics.
Well, my thesis is centered entirely on the mathematical setup. It's just unprecedented. When the short interest gets above 300% of the float is, for all intents and purposes, broken. Every single tradable share has been borrowed and sold short multiple times over. So you're effectively creating a demand to cover that is 3 times greater than the total supply available. It's a coiled spring, and that dynamic means that any sudden, non-fundamental reason for shorts to cover their positions, it's going to result in exponential, just violent price action. The downside is, sure, a near total loss, but the upside potential, driven purely by mechanical necessity, is massive.
That's a compelling narrative, I'll give you that, but I believe it completely misdiagnoses the cause. I'm coming at this from a totally different angle. That astronomical short interest is the market screaming that this company is doomed.
The extreme mechanics are a direct result of management making OSRH uninvestable. We have to focus first on the severe governance risks and the imminent solvency issues. In terms of hard data, OSRH reported just $1.58 million in cash as of Q3 2025, and at the same time, they have a negative operating cash flow. This led directly to a formal going concern warning from their own auditors, which is a critical signal that the auditors doubt the company can even operate for the next 12 months. But you can't just ignore the asset quality. OSRH possesses highly valuable, if, high-risk, scientific assets, specifically the Vaxxim immunotherapy platform, VXM01. It demonstrated an 11.1-month median overall survival in recurrent glioblastoma patients. That is clinically profound when you compare it against the historical standard of 7 to 9 months. That IP justifies management taking these aggressive survival strategies.
I agree. The science is interesting, but it's what we call a stranded asset. Breakthrough science is completely irrelevant when the company has a cash runway of less than 1 quarter. And what's more, the financing they're relying on to survive, this equity line of credit, the ELOC with White Lion, it's toxic.
Okay, so explain for our audience why an ELOC is considered so toxic in a context like this.
Sure, an equity line of credit is essentially a commitment where the company can just sell shares to the counterparty, White Lion, at a steep discount to whatever the market price is whenever they need cash. This creates constant price-agnostic dilution. We call it a death spiral because the lower the stock price falls, the more shares they have to issue to raise the same amount of cash, which of course just drives the price down even further. This is the real explanation for that 90% price erosion. And a really critical distinction has to be made here. The so-called short sellers driving your 323% figure are, in many cases, just market makers hedging the immense, predictable supply coming from this toxic financing. They're not necessarily shorts purely betting on fundamental failure.
The decision to embrace that kind of financing, though, it stems from the integrity of the leadership and their willingness to take these existential risks. Which brings us to our first core point of disagreement: the reliability of the CEO, Kuk-Hyun Hwang, or Peter Hwang.
Indeed. I mean, it is impossible to ignore CEO Hwang's history when you're discussing the company's current, very opaque strategy that involves a proprietary digital asset treasury. My core concern about his integrity and his risk management, it's really underlined by the 2003 Washington State Consent Order. That order cited Mr. Hwang for accepting roughly $89,000 of client funds, depositing them into his personal brokerage account, and then engaging in highly speculative derivatives trading. This resulted in a total loss of those funds. He was specifically cited for dishonest or unethical practices. I mean, that historical preference for high-risk speculation and, frankly, a lack of transparency, it directly undermines any investor trust in the complex financial maneuvering they're doing now.
I see why you think that, but let me offer a different perspective on the necessity of these auctions. While that historical infraction from 2 decades ago is a serious mark on his record concerning the commingling and loss of client funds, the context now is different. The current aggressive strategy is a necessary response to the stranded asset problem. The company needs substantial capital, estimates are between $50 and $100 million, to fund the promising vaccine pipeline to its next clinical milestone. They just can't access conventional financing because the market has an understandable aversion to microcap biotech risk.
But a necessary response doesn't make it a trustworthy response, not when the current actions seem to mirror the past behavior. The core infraction in 2003 was mixing client funds with personal speculation. Now, OSRH is trying to build a digital asset treasury with proprietary volatile tokens and facilitating these complex related party flows with their majority shareholder, BCM. This requires a huge degree of investor trust that these new digital assets will be strictly segregated, accounted for, and managed responsibly, and that trust is actively undermined by his historical regulatory record.
But isn't the alternative worse? I mean, what if this highly promising, potentially life-saving cancer treatment fails just because they can't raise $50 million through traditional risk-averse means? Doesn't that make the extreme means of trying to access non-traditional, innovative liquidity, even if it's risky, justified? We are talking about a potential breakthrough therapy here.
That's a rhetorical framing that distracts from the core financial viability. Risk for shareholders is not justified by necessity when the structure of that risk is just fundamentally flawed and relies on paper value. And that structure brings us right to the economic substance of this highly publicized crypto biotech picket.
The move toward decentralized science, or DeSci, in the BCM Europe licensing deal, it is highly controversial, I'll grant you, but it has a headline value of $845 million. Management claims $30 million of that is upfront, which, proves the market recognizes Vaxim's underlying value is real and is finally being monetized. I'm sorry, I just don't buy that. Let me tell you why. When you actually scrutinize the structure of that deal, the economic substance just evaporates. Yes, the stated upfront payment is $30 million, but that payment is split 50-50. $15 million in cash and $15 million in digital assets. The cash portion itself is minimal for what they need, but the asset portion is where the real problem is. An asset is an asset as long as it can be liquidated.
But it can't be liquidated in any meaningful way. The counterparty, BCM Europe, is an affiliate of OSH's majority shareholder, Peter Hwang's BCM. That right there suggests manufactured value, not an arm's length negotiation. And more importantly, the asset being transferred is the Taekwondo Access Credit, or the TAC token. This is an extraordinarily illiquid asset. Its reported daily trading volume is only $1.44 million.
But $1.44 million a day isn't insignificant for a microcap.
It is when you need to realize $15 million. If OSRH tried to liquidate $15 million worth of TAC tokens to fund their R&D, they would instantly crash the price of the asset entirely. The token is already depreciated by 80% over the last year. Attempting to sell even a few $1 million worth would expose the superficiality of that $15 million balance sheet entry. I mean, it would render it inflated and essentially fictional when it comes to deployable capital. They're creating paper value.
But the goal is to get around the traditional financing roadblocks. The structure provides an immediate influx of assets, which could potentially be held until liquidity improves or may be used as collateral. It's a creative risk management strategy. They're trying to monetize an otherwise stranded piece of IP that the traditional markets just refuse to touch.
And it invites immense regulatory peril, which links back perfectly to the CEO's history. Holding a proprietary, volatile digital asset treasury made of TAC and other cryptocurrencies, it invites heightened SEC scrutiny, particularly regarding compliance with guidance like SAB 121.
Could you clarify for the audience why SAB 121 is relevant here?
Sure. SAB 121 requires companies that hold crypto assets for others to account for those assets as liabilities on their balance sheet, and it sets very stringent requirements for safeguarding those volatile assets. Now, while OSRH might argue they're holding these assets for themselves, the optics are just terrible, given the CEO's prior consent order about commingling and losing segregated funds. They are exchanging a high-quality scientific asset for a highly suspect related party illiquid digital token. And they're doing it in a way that risks further regulatory headaches which no sophisticated investor should tolerate. This forensic audit of their corporate moves brings us to the ultimate tension in this equity. Which force really dominates the price action? Is it the constant structural dilution from the ELOC, or is it the mechanical pressure of the short squeeze mechanism from the broken float?
It has to be the dilution.
The ELOC dilution is a constant structural headwind that just overrides all the technical noise. As OSREH keeps issuing new shares at a discount to White Lion to raise the small amounts of cash they need every quarter, those shares flow into the market, driving the price down toward its fundamental zero-sum conclusion. The predictable outcome is that this stock will trade down toward its microcap peers, which are valued in the 5 to 10 cent range.
That's an interesting point, though I would frame the role of the shorts a bit differently. You said that many of the short positions are market makers hedging the ELOC supply. Doesn't that mean that as long as the ELOC is active, that hedge supply acts as a perpetual cap on the stock price, regardless of squeeze potential?
Exactly. The market makers need to short to hedge the supply that they know is coming from the company. The only way the price truly rises is if the ELOC is terminated. But management can't afford to terminate it because they'd immediately run out of cash. The shorts aren't just betting on a rumor. They are betting on a predictable economic failure that's dictated by the very terms of the toxic financing.
But you can't just dismiss the mathematical pressure of that 323% short interest. While dilution is a powerful negative force, the short overhang makes the stock highly susceptible to non-fundamental price movements. Let's look at the cost of capital for the short sellers, that 134% borrow fee. Yes, it signals extraordinary convection and insolvency, but it also increases their cost of carry exponentially. They are paying a huge premium every single day to keep that bet open.
They pay that premium because mathematically, they believe the stock is going to zero faster than the interest accrues. It is a calculated risk. It's based on the inevitability of the dilution and the insolvency notice.
But their extreme vulnerability is precisely what creates the asymmetry for my position. If a meaningful catalyst occurs, let's say the expiration of the insider lockup agreements on January 1st, 2026, passes without the anticipated flood of insider selling, the shorts who front-ran that event would be trapped by the mechanics of the broken float. They would need to cover, and there are literally 3 times more short positions than shares available. This is the definition of a mechanical reversal.
A genuine super squeeze is a statistically viable outcome precisely because the underlying business is so weak and the short positioning is so extreme. It is a bet purely on market structure failure, not on the success of the business.
But what happens the day after the squeeze, if it even happens? The dilution mechanism is structural. It's constant. Any spike will be met instantly by the company issuing more shares to capitalize on the momentary high price, which just accelerates the eventual decline back to 5 cents. You're betting on volatility, not on value.
It is a bet on the failure of the short thesis under very specific technical conditions. The fact that the high borrow fee even exists is proof that the risk is real.
And that remains the crux of the dual reality. The technical structure presents a high-risk trap for short sellers, sure, but the fundamental structure, dominated by the ELOC, presents a near-certain value trap for any long-term investor. Absolutely. So what we've really explored today are two distinct realities operating at the same time in one single equity. On one side, we have the critical tension created by OSRH's deep governance flaws, the historical financial mismanagement, the reliance on these opaque, related-party crypto deals like the TAC token, and the acute insolvency risk that was flagged by the going concern warning. And on the other, you have the unprecedented market mechanics, the 323% short interest, and the staggering 134% borrow fee, which maintain this low liquidity, high volatility environment where technical forces have completely decoupled the price from underlying fundamentals.
I still maintain that OSRH equity is not a stable investment, but it's a high-risk gamble on market structure failure. The risk of total loss is balanced against the potential for a massive, temporary price spike driven purely by the shortage of available shares. It is the definition of an asymmetric trade, and it's suitable only for those who understand and can accept that mechanical risk. And I'll just reaffirm my core conclusion. Despite all the technical noise in the squeeze narrative, the company's fundamental profile, the imminent solvency failure, the governance red flags, and the exponential dilution from the toxic ELOC financing, it makes OSRH fundamentally uninvestable for any party who relies on due diligence, accounting reliability, or sound corporate governance. This forensic analysis of OSR holdings really demonstrates the complexity of analyzing equities where technical market structure forces have just overridden fundamental reality, forcing market participants to choose between corporate solvency and mechanical necessity.
Leaving the observer to weigh whether the tail of the trade truly wags the dog of the business.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.